the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hello and welcome to the Property Pod, South Africa's leading property investor podcast, right here on Moneyweb. On this weekly show, we gain insider insights from leading executives, analysts, developers and entrepreneurs in the country's dynamic real estate sector. We have a heavyweight guest on this latest podcast who will give us a broader perspective and insights on the SA economy, especially with what's happening in the world right now with the economic fallout from the Middle East crisis, and that's following the US airstrikes on Iran. Now, it's a privilege for me to welcome one of South Africa's top economists to the podcast. His name is Goolam Ballim, and he's the chief economist at Standard Bank Group. Goolam, it's your first time on the podcast. Welcome.
Thank you for having me and for that very, very flattering introduction. I'm not sure I'm worthy. And probably the next couple of minutes will justify that I am not worthy.
Well, it's a little bit of crystal ball gazing, but I know Arik, our editor, is a fan. He says, get Goolam for budget. So he must be correct. Goolam, I'm throwing you a little bit of a curveball here, but it's a crazy week, isn't it, considering what's happened over the past week, and now the oil price is over $100 a barrel.
So you're correct in suggesting crazy to the extent that it is a shock, and many would have said unanticipated. And without wanting to appear conceited, I think this was certainly foregrounded last June when Israel attacked Iran, and of course subsequently elevated geopolitical tension combined with the US massing its troops in and around Iran would have suggested that a strike and an attack was imminent and has come to pass.
Now, it's a very different circumstance we find ourselves in. Granted, you say there were some signs last year, but I'm talking about your presentation a few weeks ago in February, the economic briefing that Standard Bank had at its head office in Rosebank, where you spoke. As I said, a lot has changed in the last 2 to 3 weeks, but what's your take on the current shocks with oil over $100 a barrel? This morning it was at $115 at one stage.
Suren, so you're correct in the sense that things have changed quickly. About a month ago, it was Standard Bank's view, and I'm sure the consensus would have been aligned, that global growth in 2026 is likely to be steady, even if unspectacular. We had numerous tailwinds, which included a general easing in interest rates around the world, which created an easier financial climate. Households around the world in many economies were an underpin to global growth. Elevated stock markets added a wealth effect to the propensity to spend. And all in, it was a scenario where 2026 and even 2027 was looking fairly respectable. However, as you say, the assault on Iraq by the US and supported by Israel has, of course, now introduced the idea of stagflation. So it feels like 1970, or at least the 70s, where global growth is going to recede and inflation is going to accelerate. And the extent of dent to global inflation and the extent of hit to global growth is, of course, going to be linked to the duration of the conflict. For the moment, Iran seems to be signaling an appetite for attrition. And similarly, the United States also doesn't seem to be expressing an end game. And I think at the outset, they would have thought that this would be swift. But clearly, it all is premature for the U.S. in the sense that now we realize that they also don't have sufficient oil inventory to carry them for an extended period of time. So at this juncture, the U.S. has miscalculated. And I think in that miscalculation with regard to how easily they thought they would topple Iran is a miscalculation with regard to unintended economic consequences.
Now, turning to South Africa, we are exposed quite a bit to this situation, as is most countries around the world, but we import refined oil or refined fuel. And from a SARB perspective, as we talked about, the expectation in your February briefing was 2 to 3 cuts of around 25 basis points this year. Is that completely off the table? And are we looking at a possible hike this month by the SARB, considering the oil price where it is and, the significant impact it could have on inflation all round? Diesel could go up by 5 to 8 rand, if not more, and that also impacts farmers.
It's a legitimate question in terms of the switch in monetary policy. But for the moment, rather than going from what was forecasted to be cuts to hikes, I would think a pause is also a plausible scenario. So I would suggest that the Reserve Bank is likely to pause, address the situation through the lens of hyperactive monitoring, and suggest that certainly a rate hike would be the next move if there is lingering inflation concerns. However, given that we just don't know how long this will last, I don't think the Reserve Bank is going to be ushered into a reflex panic and instantly raise interest rates. There is certainly room for it to pause and monitor the situation because of inflation being at generally low levels, in other words, within the Reserve Bank's tolerant band, and also if it's sort of a once-off hit to inflation that doesn't translate into secondary inflation. In other words, it doesn't meaningfully elevate inflation expectations. And for instance, the wage market isn't disturbed in any meaningful way, then a pause with deferred interest rate cuts could also be something I would entertain.
Now, markets are down significantly, over 10% now based on the slight decline today. Last week was 9.25%. I quoted your colleague from Stanlib, Kevin Lings, on the oil price situation this morning. But I suppose, this is the property pod, and you speak from a more, broader perspective on Standard Bank Group. But I'm sure you keep your eyes on what's happening on various sectors. Do you have any thoughts on what could happen? A lot can change, but, if these pauses happen, a few weeks ago it was quite rosy at the SA RIT conference talking about how property had grown from a listed property perspective. But now we have a shock, it's not just listed property. Even those considering buying a house might say, hey, let's pause this because there's not going to be any further interest rate cuts.
So, Suren, you're correct in alluding to the notion from a rosy perspective only a few weeks ago to one that is far more circumspect. So property, which of course, will take its cue from interest rates, and even more broader than interest rates, it will take its cue from aggregate demand. And now, whether it is South Africa or most countries around the world that are especially net oil importers, aggregate demand is going to be suppressed. And also confidence is going to be sapped. So when you combine this breach of confidence, the idea that prospective household spending is going to be cool as a function of just general uncertainty, and you're likely to face rising bond yields, in other words, medium and long-term interest rates probably perking up a little bit, combined with, as you and I discussed at the opening, short rates not declining further. So certainly this is not going to be encouraging for the property sector and will effectively signal that was once upon a time, just 2 weeks ago, say, tailwinds is now flipped and morphed into mild headwinds for the moment.
Now, you talk property there, but another area that you highlighted was, expectations, the positivity, the reforms, seem to be gaining traction in South Africa. And, we could see an uptick in fixed capital investment. I gather, is it too early to say that also could take a hit?
Look, at this juncture, all bets are off. At this juncture, we must take into account a very meaningful dent in global growth. That could be 1 percentage point, at least, particularly if the assault on Iran remains protected and Iran remains relatively resilient and thus pursue an attrition process. then of course that is going to be meaningful to subtracting from growth. And of course, I think we must also consider the possibility that global inflation could be at least a percentage point higher. I mean, we have to take into account, this is not just the risk of oil prices rising by, say, $10 per barrel over the near to medium term staying sticky, but this could be a far larger oil price increase that stays sticky for a length of time. I mean, we must appreciate now many Middle Eastern countries are ceasing production simply because their storage facilities are at capacity. And even if there was this, let's say, from what it seems like a miraculous calm that befall the entire befell the Middle Eastern region, it's not like those Middle Eastern oil supply machinery can be switched on with swiftness. If anything, it'll take a while for the infrastructure to recalibrate and to be re-engaged. So shutting down is a little bit easier than switching on. And that in itself could introduce a sense of protracted stabilization to the supply side of the oil market.
Now on the rand, what's your thoughts on the rand? It's currently trading around 16.80 to the US dollar. That also impacts, the local conditions, as it were, considering the optimism we had a few weeks ago with it trading below 16 rand.
So the rand has resolved to a weaker location quite simply because the dollar has been burly. So in an environment of dollar strength combined with risk off sentiment, it's expected that the rand would weaken the way it has. And I would argue the rand would have probably weakened more were it not for some positive terms of trade profile enveloping the rand. In other words, the elevated level of commodities generally is helping the rand maintain some composure. And in effect, it's buffering South Africa on the whole. So elevated commodity prices, admittedly select commodity prices, is providing some counterweight to our negative growth prospects from the Iranian shock, firstly, and it's also curtailing even more meaningful rand depreciation than that would have been the case.
And what have you changed your expectations on SA's economic growth for the year? Is it too early to comment on that?
No, it's not too early. I mean, as Keynes said, when the facts change, we change our mind. And the facts have materially changed in terms of not just the oil price, which obviously is a barometer of oil energy insecurity, but quite simply, we now have a war in the Middle East with a superpower involved. So this is different to June of last year when Israel attacked Iran, with, of course, support from the United States. But in this instance, we have United States military might being brought to bear, and the United States confronting an Iran that hasn't, that is maybe bent because of the strength of the assault, but it hasn't buckled. And Iran is also very smartly attempting to engender numerous choke points and use that as pressure, I guess, ultimately, in terms of the type of negotiated settlement, if that comes to pass. But for the moment, Iran will seek to bring the global economy to heel, given that that is one meaningful avenue for expressing its own ambitions and also maintaining some level of diplomatic and geopolitical heft. Otherwise, it becomes quite easy for Iran to be dictated to. So creating meaningful pressure points across the region, and particularly with regard to global growth, amplifies Iran's authority in this tense situation.
SA growth-wise?
So we had anticipated roughly 1.5% growth for 2026 and graduating to about 1.8% next year. But quite clearly, we will have to trim that. And, the idea of 1% growth in 2026, if there is duration to this conflict in the Middle East, it certainly becomes plausible.
Now, before you go, Goolam, how can South Africa try to mitigate the impact of the Middle East crisis and the oil price fallout? Can we really do much? Because as the finance minister said last week, we are a price taker Is it plausible for government to maybe step in on the fuel price side? I know during COVID, for example, they stepped in and had an emergency reduction in interest rates, but it's not exactly the same kind of fallout, is it?
Suren, one doesn't want to be a deer in the headlines and just submit to the situation and suggest that there is nothing in mitigation that we can do. But at the same time, one has to also accept that this is a global phenomenon, that one is dependent on international oil markets. One is definitely a price taker, and there is only so much of offset that one can inject, particularly when you find yourself in a fiscal consolidation zone, and especially where you're trying to have your debt to GDP ratio crest this year. So in that respect, South Africa's hands are tied in many respects. That said, if we remain committed to fiscal consolidation, that's likely to be welcome. If the government does not offer reflex measures like, as you preferred, offering subsidies that we can't afford at this stage, but in a sense taking it on the chin. But at the same time, just continuing reform measures, whether it's electricity, logistics, or broader areas of crime, so that when South Africa and the world does emerge from this ghastly situation, that South Africa finds it on firmer structural footing. So if we, in 2 months' time or 3 months' time or whatever it takes, emerge from this thing that South Africa did not take its eye off the reform agenda, we find ourselves with greater capacity in the logistics arena. Electricity continues to be secure. And, for example, with regard to crime, we continue to march positively in addressing especially organized crime. Then it means that South Africa emerging from this will find itself, when risk does switch on globally, that South Africa is a preferred destination. So in a sense, nurse what structural reforms we can, and at the same time do what we can and hope for an international diplomatic solution, whether it is China, Russia, or others, that bring the situation to swift settlement.
Goolam, we'll have to leave it there. I'm sure we can talk much longer. I appreciate your time on the podcast, and apologies that the video didn't work out. That was Goolam Ballim, the chief economist at Standard Bank Group.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter at Suren Naidu for more of his property industry content and other business stories.